Thank you very much for joining us on the webinar today. My name is Sudarshan, and I will be taking you through today's webinar. February was a significant month. We had the budget, and for the first time, we had the budget held in February, and not just that, we had the budget, the union budget held along with the railway budget. Now, we've also had quite a few macroeconomic events, geopolitical events that have happened across the world, and they are likely to have quite a bit of an impact on our investments and on your pocket as well. If you had joined us for a previous webinars, this would have been the sequence. We looked at the global macroeconomy, the Indian economy, a special event that we will be discussing for the month, and how these factors affect your finances, and finally arrive at your investment strategy. But for change, we will look at the budget first, and then the Indian economy and the macroeconomy, and finally how they all affect your finances and the investment strategy. Budget 2017 had a lot of themes to it. There was the theme of the rural upliftment, electrification of villages, improving farmers' income and productivity, bringing more of the parallel economy to the mainstream economy. But for now, we will be looking at only 4 key themes of the budget. The fiscal discipline, financial prudence introduced, the push for a digital India, employment generation, and finally affordable housing. If we look at the financial discipline and fiscal prudence, the budget for the coming financial year of 2017 to 18 is pegged at 21.47 lakh crore. The fiscal target for the same financial year is set at 3.2% of the GDP. Over the long run, this is set to be pegged at 3% over the next 3 years. The revenue deficit is pegged at 1.9% for the coming financial year, and because the government wants to follow a sustainable debt path and at the same time maintain its fiscal discipline, the budget is proposed to limit the borrowings from the market at 3.48 lakh crores. The second theme that we are going to talk about is Digital India. For those who do not have access to internet banking, the government is proposed to introduce Aadhaar-based transactions. There's an increased push of point-of-sale machines, which are basically the machines that are used for debit card and credit card purchases at shops. Then we have the government proposing to push the BHIM app for mobile transactions. The BHIM app can make transactions, can enable transactions between customers of most of the publicly listed banks. And finally, there is the introduction of the Payment Regulatory Board under the RBI. Now, why the Digital India is of significance is, well, about a few years ago, there was an experiment conducted to see the psychological effects of cash versus a cashless transaction. As it turns out, people are a lot more prone to, are a lot more free with making decisions on financial transactions when they go cashless rather than with cash. For example, if there's something that you would like to buy, and it's priced at say 22 rupees, and what you have in your pocket is about 500 rupees. Now, if you're going to pay 500 rupees for a 22 rupee transaction, you will have to get 478 rupees in change. Now, if the person you're making the transaction with does not have the cash for it, does not have the change for it, you would be a bit inconvenienced. On the other hand, if you were to pay via a card for just 22 rupees, you would gladly do it. It would be a lot less of a cumbersome activity for you. Now, apply this same logic to the whole of India. With cashless transactions, you are going to have a lot more purchases, and with a lot more purchases, it means the consumption activity is increasing, and with increased consumption activity, the overall economy is boosted. Now, if you look at employment generation, continuing with the digital transaction platform, we've had the government pushing for electronic manufacturing. There is also a push for point of sale manufacturing in India itself. The Foreign Investment Promotion Board, which basically is the regulatory authority of sorts, or more of a layer for foreign investments in India, will be abolished. The reason being, well, the Foreign Investment Promotion Board is, as I said, a layer, and the government believes elimination of one layer can make foreign investments in India a lot more easier. Now, if there is an ease in foreign investments in India, we can have increased capital, and with increased capital, we will have more investment happening, and with more investment, we will have more jobs created. There is also a push for overhauling the rural employment guarantees. Now, the push will be coming in the form of the work that will be introduced through the Rural Employment Guarantee Act. The kind of work that will be introduced through this will be it's designed to have long-term sustainable impact. For example, an increased productivity in a village. Now, industrial relations is a bit of a pain point for a lot of manufacturers because of rather overlapping rules and a rather bureaucratic rule book. There have been contentions between manufacturers and the industrial workers working in these manufacturing firms. Now, there is a push to overhaul the Industrial Relations and Worker Welfare Acts, thereby increasing ease of doing business in India, and thereby improving the manufacturing activities and job opportunities in India. Now, MSMEs comprise almost about 96% of the Indian companies. However, they have they face quite the same tax. They have pretty much the same tax to be paid as any other company. Now, the government has proposed to push down the tax on these MSMEs to 25%, specifically companies with a turnover of up to 50 crores. Now, this is a big tax break for the companies, and with an increased tax break, they also have the opportunity to add more payrolls to their firm. And last thing we're going to talk about is about affordable housing. Now, affordable housing has been given infrastructure status. And affordable housing, well, real estate boomed through most of 2000s till 2010. That's primarily due to the IT boom. Now, because of real estate booming, there have been a lot of investments made in houses without an intention of occupying them. Now, this further helped boost the price of the houses. Now, with this boosted price house, affordability of this house becomes a bit more difficult. So, in order to curb the practice of buying a house as an alternate source of income, the interest deductions for a second house has been limited to about 2 lakhs under the income tax reduction schemes. How this helps is, until now, the interest claims under the interest paid for the home loan was there was no upper limit to it. So a person buying a second house could actually avail a tax benefit at the same time earn an income while paying reduced income tax on his other sources of income. Now, with capping this at 2 lakhs, the benefits are reduced drastically. And because of this alone, yields of rental yields, which were at about 3 to 5% in India, will now reduce to about 1 to 2%. Additionally, the National Housing Board will refinance individual housing loans of up to 20,000 crores, making the affordability a lot more, making a lot more of the public access affordable housing. Tax benefits have also been provided to developers of affordable housing. Now, all of these factors are likely to help boost affordable housing, but they may not really boost real estate as an investment. Now, before Finance Minister Jaitley presented the budget, he borrowed quotes from the IMF and the World Bank as to how they described India as a bright spot in an otherwise grim world. Now, how do you measure whether India genuinely is a bright spot in the grim world? You have the demonetization, and because of which our GDP is likely to drop. But there is another way of looking at it. We can look at how the Indian rupee has performed. Now, about 1 month ago, on January 10, $1 was equal to 68 rupees 327 paise. No, sorry, 32.7 paise. Now, about 1 month later, rupee is appreciated by 1.5 rupees to the dollar, which means rupee is now 66.835 rupee to $1. That's quite a significant increase. And the biggest drop, as you can see from the graph over here, was on February 1st. Now, February 1st had two major events happening. One was the budget. Now, one way of interpreting this is a lot of the market welcomed the budget quite gladly. But there was another significant that happened on the February 1st, 2017, and we will discuss that subsequently. But if you look at the Indian economy as such, and if you look at the service, if you look at the PMI of the various economic activities like services and manufacturing, they have been quite, well, post demonetization, they have not performed quite well. A PMI of less than 50 indicates shrinking of economic activity. PMI of greater than 50 indicates an expansion of this particular economic activity, and the PMI 50 indicates neither expansion nor contraction in the economic activity. If you look at manufacturing, they seem to have been largely, the effect of demonetization on manufacturing has not been quite significant. So, for example, in November, we had the manufacturing activities, manufacturing PMI clock well over 50. It was only in December that it fell to about 49.6, but it's back in the green in January. But the same is not the story for service activities. Services were constantly were contracting for 3 consecutive months, November, December, and January, specifically because of demonetization. But if you see the PMI of January versus PMI of December for services, it's picked up. The service activity slowdown is much more better in January compared to December. And if you look at the composite PMI, it's closer to 50 than it was in December, which indicates that the economy is slowly reeling back and shaking off the effects of the demonetization. Now, with the effects of demonetization fading away, payrolls and job offers have been increasing, and have been increasing in expectations of increased consumption. Inflation was likely to have cooled in January, but the RBI did not reduce its interest rates. Governor Urjit Patel commented that banks have a lot more, retail banks have a lot more space for reducing their lending rates, because the RBI over the last 2.5 years has reduced their lending rates by almost 250 basis points, whereas the retail banks have reduced it by only about 100 to 120. Now, for the effect of if the effects of the RBI's interest rates should be experienced by the rest of India, the retail banks too have to reduce their interest rates. Now, if you look at the world macroeconomy and we look at the largest economy in the world, the United States, the US GDP expanded by 1.6% over 2016 as a whole, and expanded by 1.9% in the final quarter. Now, the 1.9% is slightly below the expected below the expected 2.2% for the final quarter. That is the quarter ending in December. But if you look at the other metrics, jobs added in January were 227,000, and that is much higher than the expected 180,000. Wage has also grown 2.5% year on year. But if you look at the unemployment numbers, unemployment was at 4.8% in January, which is low for almost 10 years. But if you look at the underlying number, a measure of those who are actually underemployed, it is about 9.4%. So underemployed are professionals who are quite highly qualified, but working in jobs that do not require as much qualification as they have. Now, this is at 9.4%, which means there is a slight concern regarding how much consumption activity will actually pick up despite the increased wage growth. Other than that, the Federal Reserve was during its last policy review did not raise the interest rates, and this was the biggest event this was the other bigger event on February 1st. Now, because the Federal Reserve did not raise its interest rates, the dollar weakened. Consequently, the rupee strengthened. The Federal Reserve did not raise interest rates because it is still because it must get a gauge of the policies under Donald Trump. Now, if he does, the policies promises which Donald Trump made during his elections, he seems to have enacted a couple of them, although they are quite controversial. For example, he wishes to ban migrants from Muslim countries, and he did so in an executive order banning immigration from about 7 Muslim countries. Now, if he acts on similar principles in some of his other policies related to boost the economy, for example, infrastructure projects, the Federal Reserve might be tempted to raise the interest rates. However, there is a lot of uncertainty regarding the policies that President Trump will carry out. So, the US Federal Reserve might not be raising interest rates for a while. But if you look at the other economic indicators for January, the composite PMI, the services PMI, manufacturing PMI are all in the green and quite significantly greater than 50, indicating the robust growth in all these economic sectors. Now, moving on to other developed economies of interest, we look at Japan. Japan, the world's third largest economy and second largest economy in East Asia. Now, manufacturing activity has picked up in Japan on the back of robust demand both globally as well as locally. Now, because of this, Japan is facing capacity constraints. This capacity constraint meaning it can now add more jobs under manufacturing. Although services PMI has been low for January, it is greater than the 2016 average. That said, Japan has been facing chronic deflation, and if you had joined us for previous webinars, we had discussed this quite a bit. In January as well, it was not able to shake off the deflation. Core CPI in January was at minus 0.2%. But that said, the Japanese economy is expanding. Wages grew in 2016 by about 0.7%. While it may not seem significant overall, but it's quite a significant event for Japan as such, because of the deflation. Wage growth also was sluggish. Unemployment rate is at 3.1%, which is at low for many decades. Now, if you look at developed economy of another interest, which is the European Union and the United Kingdom. The GDP for the final quarter for the United Kingdom was at 0.6%. This despite Brexit. Now, consumers in UK are spending despite knowing the fact that it might be a bit of despite the Brexit happening. Now, at this point, one thing should be noted is that although Britain has voted to leave the European Union, it is still enjoying the benefits of the European Union's free trade agreement and the free movement of activities, specifically because although Brexit has, although the Brexit referendum did happen, the actual separation from the European Union is yet to be initiated. Recently, Prime Minister Theresa May got the vote of confidence from the Parliament for going ahead with the separation move. Now, this will have, based on how the separation happens, there will be significant impacts on the economy of UK. Unemployment rate in the European Union as such has come down at about 9.6%. The job creation in European Union is at a 9-year high. Now, because of the Brexit uncertainty and the strengthening of the US economy, the euro weakened. The euro is trades at about 1.068 to the dollar. Now, because of the weakening of the euro, importing of commodities becomes a lot more costlier for the European Union. Now, the costlier commodities is also reflected in the inflation, which is at about 1.8%. The European Central Bank wishes to keep the inflation at 2%. Now, 1.8% is quite an encouraging inflation number. Closer home, specifically Asia Pacific, China has been growing. China's service activity, manufacturing activity, and overall activity has seen strong growth. Manufacturing activity in China has expanded, although slightly slower compared to December. Whereas Chinese service activity has been expanding at almost the same rate. Now, because of China's push to become more of a consumption-driven economy rather than an export-driven economy, it can also be seen that the jobs added under services has actually increased much more in the service sectors rather than in the manufacturing. In fact, manufacturing jobs were actually reduced in China. Now, Southeast Asia has a significant exposure to China. Now with the Chinese economy expanding, the manufacturing activity also expanded in ASEAN, the Southeast Asian nations. For example, in December, while the manufacturing activity of ASEAN was shrinking overall, it did not shrink in January. That does not mean it expanded, but simply means that it did not shrink. So the GDP of Indonesia, which is one of the largest economies in Southeast Asia, grew by about 5%. But the Vietnamese economy, which is modeled quite similar to the Chinese economy, slowed down, experienced a slowdown. And like the European Union, the commodity prices are driving up the supply side inflation of the manufacturing dependent economies. Now, speaking of commodities, commodities are one of the biggest contributors to the economy of Latin America and Africa. If you look at the Latin American economy, Brazil, which is the largest economy of the region, continues to be in a recession for the third consecutive year. Employment rates continue to fall in Brazil. But there is a bit of a green shoots appearing, specifically in the form of inflation. Brazil's inflation were in double digits through most of the first half of 2016. Towards the end of 2016, Brazilian inflation came down, thanks in large part due to the Brazilian central bank. Thanks largely to the Brazilian central bank's decision to keep interest rates high. Now, this in turn has benefited the inflation. The inflation of Brazil CPI is now by 1% compared to in December. Brazil CPI is about 5.35% in January. Now, this will encourage the Brazilian central bank to reduce its interest rates. Now, with the reduction in interest rates, we can expect economic activity to pick up in Brazil. Mexico, on the other hand, has a large exposure to the United States. So despite Donald Trump taking a presidency, manufacturing activity did pick up in January 2017. However, Mexico has nearly 25% of its trade exposure to the United States. That will mean that the Mexico depends. The economy of Mexico depends a lot on Donald Trump. If he does go ahead with his promise to create an embargo of sorts with Mexico, Mexican economy will also be hit. If you look at the commodities, oil, which rallied towards the latter half of 2016. It rallied through November and December, but the prices held steady through most of January. Now, the rallying of oil prices was primarily due to OPEC's and Russia's decision to cut down the oil production. However, demand is yet to pick up because oil inventories in US are still high, and demand for oil in China, which is the world's largest importer, is still low. Gold, on the other hand, is rallying. While it fell to the latter half of 2016 due to a reaction of sorts of Donald Trump becoming president, the markets believed that Trump's policies will mean that the U.S. economy will strengthen, especially his promises on investing more in infrastructure and a bit more of spending. However, the actual implementation of these, actual executing of these promises are yet to be seen. And with a bit of volatility coming in the form of Trump's policies, for example, withdrawing from the Trans-Pacific Partnership, there is quite a bit of a downside to the American economy. The Trans-Pacific Partnership, for example, is a sort of a free trade agreement between many East Asian countries, Australia, New Zealand, and the United States. Now, with the United States pulling out of the Trans-Pacific Partnership, there is a likelihood that the economy of all these regions may not grow as strongly as they could. The Japanese economy, for example, could have grown by 2% had the Trans-Pacific Partnership pushed through. Now, all of these factors indicate that the U.S. Economy may not be as strong under Trump as expected. So the dollar began to weaken. Now, with the weakening dollar, we look at gold prices rallying. Now, considering all of these factors, we look at how these will affect personal finance. One aspect of the budget was a tax system honoring the honest, and also a scheme to bring more people from the parallel economy into the mainstream economy. Towards these two moves, the tax for an individual earning income between 2.5 to 5 lakhs was reduced to 5%. Now, if he makes prudent investments, a person earning an income between 2.5 to 5 lakhs will not have to pay tax at all. Now, because of the reduction of tax from 10% to 5% for the tax bracket of 2.5 to 5 lakhs, there is a bit of a cascading effect as well. So, for example, for an individual earning an income of between 5 to 10 lakhs, in the previous budget, in the previous tax system, he would have had to pay 25,000 rupees plus 20% of the amount exceeding 5 lakhs. Now, he will have to pay 12,500 plus 20% of the amount exceeding 5 lakhs. That basically means a 12,500 rupees reduction in tax that the person has to pay. Now, because of the government's push to manufacture electronic goods locally, imported electronics will attract more taxes and duties. Printed circuit boards, which are one of the more important components of phones and LEDs, will attract more duty. So even if a phone is manufactured in India, it'll still be a bit pricey due to the importing of the printed circuit boards. Online railway booking will become cheaper because the union government has proposed to remove the surcharge for tickets booked over IRCTC. Now, this is also a push towards digital India, and this is also a budget for the Indian Railways as well. Imported silver goods like coins and medallions will become more costlier because they will also attract a bit more of duty. Now, as we had discussed under budget, there will be reduced tax benefits for those buying a second house. And if they are planning to buy a second house for the sake of rental purposes, then it will they will not be able to avail the full exemption of the interest rates under the income tax. They will only be able to avail up to 2 lakhs of benefit. Now, because of the 2 lakh benefit, the rental yields will also be much lower. If you look at the global macroeconomy, with the dollar weakening, some of the commodities will become costlier, but at the same time, the rupee is also strengthening. So, oil prices, as we had seen from the previous graph, are ranged. So, with a strengthening rupee, India can import more oil for the same price. Essentially, petrol, diesel, fuel prices will remain unchanged, or if there is a change, there will be a reduction in these prices. Now, with a stable fuel price or a reduction in fuel price, inflation food inflation, for example, will be a lot more stable, because fuel is a significant cost while transporting foods from the farms of India to the markets. However, other commodities are rising, are rallying. Now, because other commodities are rallying, importing goods goods prices will also go up. So, imported commodities, so goods that require imported commodities will become costlier, or imported goods themselves will become costlier. Looking at all of these, how do we come up with an investment strategy? So, the Indian economy has mostly shaken off its sluggishness, as can be seen from the PMI. It's trending more and more towards 50 and above. After the demonetization, the economy has picked up steam. Many companies are increasing their payrolls, expecting improved consumption. So, with an improved consumption, the overall economy will also improve, and this is an effect of the digital push as well. The Foreign Investment Promotion Board, which was basically an extra layer for foreign investors in India, will be removed. Now, with that removed, we'll have improved foreign investments in India. Improved foreign investments will also mean a boost to the equity markets. So, considering all of these, it makes sense to have equities for the longer run rather than trading it for immediate gains. Gold thrives during turbulent times, and with a bit of an unpredictable policies coming out from the government of the United States, and the Federal Reserve also being uncertain of raising their interest rates, the dollar will weaken, and this in turn will result in gold rising. Additionally, with Brexit coming up, key elections in Germany, in Netherlands, and France, all of these will test the stability of the European Union. Now, that essentially means there might be turbulence coming in the way from the European Union as well. All of these will once again help gold rally. So it will be good to have about 5 to 10% of gold in your portfolio. Now, during demonetization, we had equity markets crash, and gold was also crashing. However, one asset class that did not crash were bonds. In fact, bonds continued to rally through most of November. There was a slight correction during December, but the correction lasted for maybe about 2 weeks. And bond resumed to rally afterwards. Bond markets will continue to rally in the future, especially considering the fact that the government is adopting more of a prudent financial plan. Government is being more prudent with its finances, introducing more of fiscal discipline. This will imply that the quality of government bonds will improve. That in turn will attract more and more bond investors in India and abroad. Now, with the push with the increased infrastructure investments, bonds will once again continue to attract more investors. because a push for infrastructure will be reflected both in GDP as well as the finances of India. Overall, the tax revenues become more and more transparent, become more and more improved with Digital India and some of the data mining that was done with the demonetization. So overall, finances of the government will be expected to improve, and this will make the government of India bonds a lot more attractive. So overall, bonds, having exposure to bonds in the portfolio will be beneficial. That brings us to the end of our webinar.